It only took a few days in November last year for cryptocurrency exchange FTX to fall apart. From a report concerning potential leverage and solvency at a trading affiliate, the saga quickly spiraled into a liquidity crisis that sent FTX to bankruptcy and its CEO facing criminal charges. FTX now belongs to a select group known as Unicorpse, marking its demise from being a multi-billion-dollar unicorn. It's a fate shared by Silicon Valley's Theranos, the defunct blood testing firm whose CEO has been sentenced to jail. Around 44 founders lost half their wealth, valued collectively at about $96 billion in the past year, amid the crypto decline and funding slowdown. That's according to Forbes. It's a far cry from March 2022, when the founders were worth $190 billion.
The industry, if you will, likes to focus on successes. The reality is quite a bit different. Startups that started up with an intention to seek and gain venture capital. 1 in 10,000 would eventually make it to about a billion-dollar valuation, and then from there, a fraction of that would then exit.
Venture capitalists say there are some common red flags.
There's always a common thing when there are pitfalls. There were enough companies in the last several years that were built for the bubble, but what's really critical is, are they built to last? And I think there's more commonality when companies don't scale. For example, an inability to hire the right talent. Thinking about what product market fit is there, or just thinking about things like pricing, differentiations.
I think raising too much money too quickly and at a high valuation and pursuing a growth at all cost model, that's one. Second, investing too much on hiring sales force to scale when you haven't found a product that actually answers a customer's need. And third, reading the scaling as well, scaling to other region too quickly without holding true to the culture and the mantra of the company itself.
That aside, the spectacular fall of startups like fashion e-commerce firm Zalingo highlights some red flags that investors seem to have overlooked.
CEO stardom seemed to be a big factor in these failed unicorns that you hear over and over again, like these founder CEOs that are revered by everyone. So in that sense, things that cloudy and muddy the aura of the deal away from its fundamentals, away from a sort of intellectually honest way of viewing it, are dangerous.
Experts say it would pay to be more discerning about trends as well. And just because other established venture capitalists are lining up, it doesn't mean a startup is always worth its salt.
One big lesson is beware fads. There was, for instance, the Web3 fad, which resulted in a huge wave of investments in Web3 related companies that today we see come crashing down for various reasons.
It takes a village to grow a company and to a successful one. And similarly, I think on the way down, there may be a few that are responsible as well.
A way to mitigate potential irregularities is by putting corporate governance systems in place early on.
There are controllables and things which are out of your control. On the controllables part, it is around saying, at least making sure you've had those conversations and the teams have had conversations about that path to profitability.
For startup unicorn LiveSpace, having strict corporate standards is a priority. Its key focus remains on value creation rather than valuation.
High-quality teams, the ability to build gross margin, generate a predictable path to profitability, long-term sustainability, good culture, good reputation in the customer's mind, high NPS. If we focus too much on valuation versus value creation, you will 100% miss the boat.
LiveSpace is a renovation marketplace that operates in India, Singapore, Malaysia, and the Middle East. Its CEO is unfazed by prospects of failure, even as the company earmarks up to $100 million in potential acquisitions over the next 2 years.
Successes are actually just a fraction of the total number of things that you're trying, which means that you must be failing in many, right? So if you're super ambitious, then you will do a lot of things, and you'll, by definition, law of mathematics will actually lead to failure in a few.
With survival now even more crucial as capital remains scarce, many startups are keeping tabs on profitability and reducing cash burn.
While the demand is still there, the cycle to convert customers higher. But the good news is that they can shorten the overall cycle. They're within their control by reducing onboarding time and so on and so forth. Talent, always important in scaling. Now, the good news is that with this downturn, talent is now more readily available as well.
Exits have been harder, and you still expect IPOs to kind of be harder this year, but there are opportunities with M&A. The biggest challenge right now for startups, but even companies more broadly, is adapting. And you will still see some great founders, great companies emerge despite all the headwinds. It's still an incredible time to be an entrepreneur.